Okay, picture this. You're a small business owner, you've been working your tail off all year long, and then your tax person hits you with the news. You owe the IRS more than 6,000 bucks. Ouch. Well, that was the exact reality for one construction company. But what happened next? Well, it was an absolutely incredible financial turnaround. So, how in the world did a company turn a huge tax bill into an even bigger refund? Let's get into it.
I mean, just look at the numbers here. The original filing showed they owed $6,300, but after a really deep dive into their financials, that became a refund of over $14,000. That's not just a little adjustment, that's a complete 180-degree flip. When you do the math, that's a net swing of over $20,000. And that's the big question here, right? How does a $6,000 tax bill magically become a $14,000 refund? Well, the answer wasn't magic. It was just buried deep inside the company's books. So to really get how they fixed this, we have to look at how broken it was in the first place. And the problem, it wasn't really the tax return itself. Think of a tax return as just the last chapter in your financial story for the year. And if that story is a total mess, well, you're not going to like the ending. This note, which was actually attached to the new amended tax return, really gets to the heart of the whole thing. The original tax preparer was basically flying blind, working with incomplete information. It wasn't on purpose, it was just a classic case of not having the full picture, and that led to some very, very expensive mistakes. And when you dig into their original profit and loss statement, one line item just screams at you. Reconciliation discrepancies of over $6,000. Now, to the IRS, that is a massive, flashing red flag. It's basically you telling them, hey, just so you know, our books don't match our bank statements. By a lot. That's pretty much an open invitation for an audit. So, to wrap up where they started, this business was in a really tough spot. They were looking at a big tax bill, their books were a total liability, and the risk of a super stressful audit was just through the roof. On top of all that, they were paying way more tax than they needed to, all while having no real idea what their true financial health even was. So, how do you fix a mess this big? Well, it wasn't as simple as just changing a few numbers on a tax form. No, this required a complete top-to-bottom teardown and reconstruction of the company's entire financial year. It was time for what we call a deep rebuild. So, what in the world is a deep rebuild? Think of it like this. Instead of just proofreading a book for typos, you're going back to the author's original messy notes and rewriting the whole thing from scratch, just to make sure every single word tells the true story. You're re-examining every transaction, putting it in the right category, and building a financial picture that's actually reliable. And the process was super methodical. First, they rebuilt the foundation, the chart of accounts, so money was actually going where it was supposed to. Then the painstaking part, recoding every single vendor transaction, one by one. After that, they tackled the bigger stuff, like inventory and assets. And that's when they found it. This deep dive uncovered a huge error that had been hiding for 3 years. Okay, this is where the story gets really fun. The deep rebuild wasn't just about cleaning house. It was like financial archaeology. You're digging through all the numbers to find those specific, critical errors that were causing all the damage. So here's the first big aha moment. There was a duplicate tax form for mileage, which was basically doubling their deduction. Now you might think, hey, a bigger deduction sounds awesome. But to the IRS, an error like that makes the whole return look suspicious. It was making their income look artificially low, which jacks up the audit risk. The fix was easy. Get rid of the duplicate and use the correct defensible numbers. The second major breakthrough was a huge missed opportunity. The business owner was running the company out of their house, but the original return had completely forgotten about the home office deduction. By using what's called the actual expense method, they were able to claim a portion, in this case almost 27%, of all their home costs, like rent and utilities, as a legit business expense. And the impact of that one fix alone? It was huge. Just by properly claiming the home office, they found an extra $3,000 to $4,000 in legitimate deductions. I mean, this was money that was just being left on the table because no one was looking at the full financial picture. But this was the jackpot. Buried deep in the books, they found a 3-year-old invoicing error that had incorrectly inflated the business's income by $10,000. Think about that. For years, this business had been paying taxes on money it never actually made. Fixing that one single mistake had a massive, immediate impact. Listen, a $14,000 check from the IRS is fantastic, no doubt about it. But the real win from this deep rebuild went way beyond a one-time payment. This was about completely transforming the business's financial foundation from something risky and chaotic to something safe and smart. Okay, this is where things get really interesting from a risk point of view. The original filing, with all its mistakes, actually showed a loss for the year. And you'd think, showing a loss is good, right? No tax. But to the IRS, a business that consistently loses money can be a big red flag. The corrected, safer return actually showed a modest profit. This looks way more realistic for a healthy business, and get this, it dramatically reduces the chance of an audit. So the transformation was just total. Financial clarity went from basically 0 to 100. The filing went from risky to safe. And maybe most importantly, trying to plan for the future went from impossible to totally doable. The owner now has clean, reliable data to actually create a budget, forecast sales, and make smart decisions for the business. All right, so this is more than just a cool story about one company. The problems they had are incredibly common, and the lessons here are universal for any small business owner, freelancer, or sole proprietor out there. So, what are the big takeaways for you? Number 1, clean books are not a nice to have, they're non negotiable. 2, little errors like that one invoice can add up to huge costs over time. 3, a deep professional review can pay for itself over and over again. 4, a safe tax return isn't about paying more tax, it's about being accurate. And finally, always remember that your tax forms are telling a story. It's your job to make sure it's the right one. This entire $20,000 swing, from owing money to getting a massive refund, came from information that was there the whole time. It was just hidden under a pile of messy records and missed opportunities. And that really leaves us with one final, very important question to think about. What hidden savings or hidden risks are just waiting to be discovered in your own books?